Fed cuts rates 50 basis points. Are you surprised? So the Fed met, cut interest rates. What does that mean for the mortgage business? Is it refinance season now? Well, not exactly, and let me explain. When the Fed cut the benchmark rate days ago, it did mark a change in direction for short-term monetary policy. For the Fed, the hiking cycle started back in March of 2022 and lasted all the way to July of 2023. So since last summer, the Fed's kept their thumb on the pause button. But that doesn't mean mortgage rates haven't changed. Here's a graph of what the 30-year fixed looks like since the pandemic, and it's clear to see that rates are coming down. In fact, rates have been coming down for the last 5 months in a row, well before the Fed cut. So with the hysteria of the 50 basis points cut, is now the time to refinance? And if so, how do you set yourself up for the very best deal? For most, refinancing is something that comes every 5 or 10 years. And unless you're buying homes regularly, the average life of a loan is about 5 to 7 years. And likely many of you refinanced for the very last time during the pandemic. So your experience will matter, and it does help. Also, it helps to have a lender relationship. But I can't stress the importance of research. May this video help you close your refinance with confidence. With the right knowledge, you'll know how to compare one offer to the next and recognize a good deal when you see one. But first, it starts with you. You're square one. You need to know your stats. And often, you buy the home, you close the loan, and you get in the routine of making payments. Then the next thing you know, you hear rates are down, but down from where exactly? Rates do change on a daily basis, but your current rate is your baseline. A great financial advisor will usually help you manage this, but it's easy enough to do on your own. There's so much information out there, and it's so easy to obtain. So if you have it, go and grab your latest mortgage statement. So it's important to review your latest statement for 2 reasons. The rate, yes, but also the balance. If your rate starts with a 7 handle, now may be go time, but if it's 5% or lower, you might be on the sidelines some more time. But let's assume you have a 7% loan. Next, you need to get your credit score. Lenders will encourage you to make application to pull your credit so they can quote your rates. But credit data isn't a monopoly anymore, and you can go to freecreditreport.com or Experian and get your scores direct if you don't know what they are right now. By law, you're allowed 1 free credit report, so you can contact them direct and get a copy online. Usually, lenders will price your rate according to your mid-score, throwing out the high and the low. Then lenders like to price your loan according to credit tier, say 740 or higher for the best possible scores and possible rates. Higher the credit score, the lower the risk and lower the rate. Just like your debt to income, but in reverse. With DTI, lower the ratio, lower the risk, and lower the rate. A quick cheat code to get your max debt ratio is that for every $1 in debt you're qualifying for, you need $2.20 of income. So let's say all your debt totals $1,000 per month with the refinance. What do you need to qualify? Well, $2,200, of course. That's your gross minimum monthly income to qualify. You follow? Once you have a handle on those 2 figures, you're looking great. Credit scores can change over time based on usage. So opening new trade lines or adding new debt could impact your scores and thus a rate from your refinance. Remember, this is a once in an every few years proposition, so you need to take it serious. You never know when the next opportunity will present itself. Next, do some shopping. Some clients like to go guerrilla shopping, which is good, but don't get so many that you can't manage it. The market changes daily, and lenders will change pricing based on their appetite and capacity. So I stress talking to all lenders on the same day and giving them all the same parameters. For example, if you estimate your home at $500,000 with one lender and $600,000 with the next, that could throw your rate quotes off. I'm a fan of talking with someone, not going online to get your quotes, because who knows who has your info on the other end. The last thing that I'd want is somebody selling your information to lenders all over town. Most lenders will work with a sharp pencil, but it's commonplace today for your lenders to want to see written loan estimates to match or beat a competitor's rate. But they'll want to make sure they have all the same stats, the same credit score, DTI, your home value, your term, and your lock period. And you need to make sure it's equal across the board to get fair quotes. Then, if you haven't received your loan estimate in writing, it's time to ask for a copy. The format now is the same for all lenders, so it should be fairly easy for you to compare. Getting it in writing will help you compare more than just the rate. You may think that the lowest rate wins, but not so fast. The loan estimate is good for two things: the rate and the fees. All lenders will have closing costs of some sort, but it could be a matter of who's paying what. Some lenders quote rates with lender paid cost. Others pitch the lowest possible rate with the max cost. So it's important to leverage the APR and understand, is a 6% rate with no closing cost better than a 5% rate with $10,000 in fees? That may depend on your goals. If you're coming down from a 6.5% rate, I can see both making sense, but it's important to understand with the lender paid option, there is no recovery period. With the $10,000 in cost option, your payment will improve, but you're going to have to ask yourself, how long is it going to take to recover these costs? What happens if rates continue to go down, say another point or so? You're going to have to amortize your last decision into the new one. When you're requesting rate quotes from some lenders, they may give you a closing cost worksheet. Some lenders will want you to take the full application so you can get the official loan estimate. Depending on the size of the institution, they may not want you to apply until you're ready to lock your rate. Floating applications could take up valuable resources from the lender, and since most of all of them have purged their support staff over the past couple of years, I would expect a short leash. If you're able to get the loan estimates, that will put you in a better situation to compare the rates and fees by each line item. The first page of your loan estimate will show your loan details as well as your interest rate. It'll give you the payment breakdown and the total payout over the life of the loan. On the next page is more critical details. The loan estimate will break down the cost of the loan, with Group A showing the cost that you can shop for. Here it IDs the lender's cost to produce the loan. Group B shows costs you can't shop for: appraisal, your credit report, your flood, and your recording. You're here for a good deal, so let's focus in on the fees in the A section, as that usually comes down to those direct lender fees and the interest rate offered. The rest of the fees are going to be similar no matter who you select, because the lender doesn't control the third-party fees. The total cost for terms offered will help you determine if the 5.5% rate with cost is the best way to go, or take the 6% rate with no cost for an even better deal. Here's another cheat. Try to get the note rate and the APR to be as close as possible, the slimmest margin. The closer it is, the lower the cost of the loan. Sometimes you need to look beyond the rate, the best rate with the least amount of cost, right? While many of the fees listed in Group B are predetermined, others, such as the appraisal fees and the credit report, aren't. It's still necessary to compare these fees so you can get a basis when doing your comparison estimates. But understand, the APR represents the cost of the loan over the term, but it's not the rate that you're going to make your P&I payment on. There's a difference, and that's an important one to understand. If you plan on taking the lower rate option, but with a higher cost, and you decide to roll those costs into the new loan amount, you need to think about your goals. Will that extra $10,000 in cost amount to over 30 years? The higher the loan balance, that'll drag on the payment improvement. So sometimes rate isn't always that it seems. I often get the question, what happens if I pay points? Points are basically prepaid interest and money used to buy down the rate. 1 point, it's equal to 1% of the loan amount. So let's figure you're borrowing $100,000, then 1 point would be $1,000. Now, the usual rule of thumb is that 1 point buys down the rate by 0.25%. But then you're going to need to ask yourself, does this really get you closer to your goals? Otherwise, you may be adding more to your balance. Remember, points have limitations on their tax benefit when you refinance, which is different than when you use points to buy the home. Sometimes there's an advantage of lowering the term, and when you do so, could lower your rate. It'll increase your payment, but you're going to need to run through the figures on an amortization schedule. Let's look at a $200,000 loan amount with a quoted rate of 5% and no points. 5% and your monthly payment based on that interest rate would be $1,074 per month. If you decide you want a lower rate, you're going to have to think about that 1 point cost to lower your rate to 4.75. Is it worth it? Well, at 4.75, let's do the math. The same $200,000, your monthly payment in terms of principal and interest would be $1,043 per month, which would save you about $31 a month, or $11,160 over the 30-year mortgage term. However, let's assume you need to bring an additional $2,000 to the closing table to pay for it. How does it stack up? Keep in mind that most people don't keep a 30-year loan for all 30 years. So instead of looking at lifetime savings, review your break-even point. If you divide the amount you paid for the point, let's just say $2,000 on a $200,000 loan amount, you're going to save an additional $31 per month. But note, it's going to take you 65 months to break even on that investment. Bottom line, if it takes you 5.5 years to recoup the $2,000 points for the lower rate, is it worth it? You're going to have to ask yourself, are you going to stay in the home long enough and keep the loan long enough to recover these costs? It might be worth it. But then again, you have to factor in that $2,000 up front. You'll save the money over the life of the loan, but let's just understand if you had to pay that money out of pocket. Now, this example covers the principal and interest payments. It doesn't take into considerations your property taxes or your homeowner's insurance premiums that will likely be included in your monthly payment. When in question, do as Ben Franklin did and write down all the pros and cons for each option. What loan is going to get you to where you want to be at the end of the year, or 5 years or 15 years down the road, if rates keep going down, down, down. And when they do, you can use this game plan all over again. It's a tried and true method, and we use it all the time in the business. Sometimes you're refinancing for a lower rate, sometimes for a lower payment, but sometimes for a reduced term. Then there are other times that you're refinancing to pull money out in what they call a equity cash refinance. In those options, the cost will be extracted from the cash back to you. But you could roll the cost into a higher rate. So the same strategy can work in all different refinance types. Yes, I always recommend speaking with a loan officer because sometimes rate quotes can be misleading. There are over a dozen questions the lender will need to know to zone in on your exact rate, your credit score, your DTI as we spoke, but then again, your location. What state are you in? All these details matter. So to get the very best rate, make sure you're giving the same data to all the lenders. And I always ask, because it happens regularly, what happens if during the process rates improve? A lot or a little, because they're always changing. You're going to need to ask your lender about a relock policy. What does it cost? What are the terms? How long do you have to wait before you close? It's always worth asking your current lender what's on tap for existing loans. Sometimes they're quick and easy. Sometimes they have reduced documentation or qualifying parameters like appraisal waivers. The very best deal may be with a full-blown refinance, but you need to ask yourself what's your time worth and what's the margin for improvement. I can't stress enough one-on-one conversation with your lender. Sometimes what you see advertised on the web represents purchase money rates, which can be different from refinance rates. Most lenders price refinance rates a little higher, but you can call and confirm with a telephone call. One last thought. Rates can vary with programs. VA rates may be different from conventional and higher or lower than FHA programs. Some lenders specialize in one type of program. If you're looking at a loan with mortgage insurance, it's always good to compare those options, just like closing costs. There are options for mortgage insurance for lender paid and borrower paid. That's a big factor in the interest rate when it comes to MI. Now, in general, the lower the risk, the better the rates. But loan size, term, your loan to value, your credit score, your lock period, all factor into the final rate you receive. Now, sometimes your rate can even change post-lock if the appraisal comes in lower. Or inversely, if the value comes in higher, it could help out and lower your interest rate. So having the rate locked is a start, but it doesn't mean it's final. That comes with final underwriting approval. And understand once you lock, you're on the clock. You need to get the loan closed and funded within that lock period. It's a very good idea to compare different lenders, but also different institutions. Some banks, some brokers, some credit unions. That'll give you more options and more choices. Sometimes you can get great portfolio options from a bank versus a credit union. or vice versa. But generally, they will all want to ask you the same questions. Last tip, in case you're wondering, where do you go for rate info? I like to use Mortgage News Daily. You can compare rates and get intel on the bond and coupon market. Ultimately, it's a secondary market that's shifting interest rates, not lenders, definitely not the Fed. This is the loan business and it turns on a dime, with and without the Fed. So I'm going to tell you, like MG told me, the loan biz is full throttle, no champagne bottle. That's it. I'm back to work.